Today in this video, I'm going to show you how to trade before a fair value gap can happen in the market. So without wasting any of your time, let's begin with the video because we're going to cover a lot of things. Here, I'm going to show you how to trade this model efficiently. And also, I'll show you the steps to use to trade this model the correct way. It's very simple to understand. You don't have to know anything or any strategy. It's just simple to understand. The first thing that you need to understand is to understand how a fair value gap can be spotted in the market. So in simplest term, a fair value gap can be seen by a gap in the market between three candlesticks. We have 1, 2, 3. The wick of candle 3 and the wick of candle 1 doesn't trade in the same price point. Like there will be a gap in between like this. The same applies on a bullish trend. You will see that this week here and this week here, we have a space in between them. This is an FVG. But here in this video, I'm going to show you how to trade before this fair value gap can be created in the market. So that means you'll be entering your trades around this area or even here before this can happen in the market, because most of the time before a fair value gap can be created, the market will create some sort of a signal so that you can enter the market before that. And a fair value gap, most of the time you will see that the market is very volatile when the market creates those fair value gaps in the market. So I have few slides here so that you can understand and see how a fair value gap will be created in the market. We have this first one over here. You can clearly see that we have an FVG here, but most of the people will be looking to enter the market right there. But how about we catch this move before this fair value gap can happen? This is where this model comes in, because you will be looking to enter the market around these areas. It all depends on how you view the market. In this situation, we can see that we have a break of structure and then we have a break of structure here. This is where you should be looking to enter the market after this candlestick, because before a fair value gap can be created, you will see that there will be some sort of manipulation in the market before we can see a fair value gap that is happening in the market. So for this example here, this one is very difficult to trade because it even traded below this one and the second candlestick traded below before we can see this fair value gap. So in another way, this model works in a way that you have to trade before a fair value gap can happen. If there is no fair value gap in the market, that is when you should look enter that market. So in another way, in this situation, you can see that we have an FVG here, but on this area, we don't have a fair value gap. This is an area where we should be looking to enter the market. The first step that we can do is to identify the swing low that has been broken, and then we confirm with price action. So with this price action here, you have to see that we have a manipulation here, and then on this candlestick, when this candlestick closes, you should enter the market around these areas here. When price opens with this candlestick, the retracement will be where you should be looking to enter the market, and then your stop loss will be below here. Unlike this one obviously, because we can see that the structure started from here, your stop loss should never be below this area. It should be around this area to avoid this unnecessary stop losses before the market can move to the anticipated direction. So in another way, in this situation, when this candlestick opens, it will open around this area. This is an area where you should be looking to enter the market. And then when price move to the upside, when it breaks this area, you can move your stop loss to maybe break even. Okay, so let's look at this example here. We can clearly see that we have a move to the upside, and then we have this bearish engulfing candlestick. Then on this bearish engulfing candlestick, this is where you should be looking to enter the market, because we don't have a fair value gap. You have to see a fair value gap. You don't have to wait for the fair value gap to be created in the market. You have to trade before that fair value gap can be created. If you see that we have created that fair value gap, then we have to wait for another setup. But you will understand this very clearly. I know it can be a little bit difficult to understand, but it's very easy when you backtest a lot. But you will see with some few examples when we move forward. Here, this is another one here. We can see that we have a fair value gap here, but we have to trade before this move can happen. We can clearly see that we have a move that trades above this highs here, and then we make this strong shift to the downside. Obviously, on the next candlestick, this is where you should be looking to enter the market. And most of the time, this high here is likely to touch the previous candlestick. So that means if, let's say, you are using the 4 hours time frame, you can move on to the 50 minutes to catch the smaller risk to reward in the lower time frame. I mean a higher risk to reward in the lower time frame. That's how at least you can try to understand it. So basically, we don't wait for a fair value gap to be created. We have to wait for the move that creates that fair value gap in the market. Let's look at this one and look closely. Before this fair value gap here, if you move on to the lower time frame and trade here, you will catch this whole move that is very fast. Even if you look at this example here, you can see that we trade above and then we reject to the downside. But then on this next candlestick, we have to wait around this area to enter. This is where you should be looking to enter the market. And then when you catch that move, the next candlestick or after 2 candlestick, price should create a fair value gap in the market. That's how at least you can try to understand this very efficiently. So right now, if we move on to a real chart, you will understand and see those kind of moves in the market. Let's try to look for those examples and see how the market is likely to behave. This is not a big testing video, but it's just something that I wanted to share with you guys. This pattern will always repeat in the market. If you look closely here, let me increase the size. If you look closely, before we can create this fair value gap around this area, the market made something here. If we move on, let's say to the, because we're on the daily, if we move on to the 30 minutes, let's see, this is an area where the market, before it can create that fair value gap, it created these moves here to the upside. This is where you are likely to go short in the lower time frame. And if you don't see those kind of market structures in the market and you are wondering why my chart looks like this, is because I'm using an indicator here. If you want this indicator, I'll find the link in the description below, because I don't have to identify market structures, lower highs and higher highs, because it's just a waste of time for me. So by using this indicator is helping me to minimize those analysis. So right now I can make my analysis very quick. So here, and if you're wondering about my settings, here are my settings. I don't have anything here, just a change of character, market structure. Normally I like to leave everything to the default section. Okay, I hope everything, you can pause the video and then copy my settings, but everything is just on default settings, but you can change everything. So basically here, before the market can create a fair value gap, the market will always give you a signal. Even on this area, before price can drop to the downside, we can see a lot of price action here. Why? Because we can see a rejection to the upside and we don't have a fair value gap in this area. That is why we see a fair value gap after that move here. So basically what you can do is to read price action. Even if on the current price action here, let's look and see we have a higher high. Basically we might be creating another higher high. You can see that after we broke this low here, price rejected. You can clearly see that we obviously rejected here, guys. And then on the next candlestick, the market retraced and moved to the upside. So every time when you see that we broke the low, the next candlestick is giving you a sign of a reversal, then that's when you can try to look in the lower time frame and look to enter around these areas here before a fair value gap can be created. That's how at least you can try to understand this. Before a fair value gap can be created in the market, there will be a sign of a reversal. Let's look at this example here. This is a decade on the 30 minutes time frame. If we look closely, we broke this low, and then it's just that the market is very slow currently. We rejected. Look at this candlestick. It shows a sign of a reversal. Before this fair value gap can be created in the market, here, you have this fair value gap. Look at what price action did. It tapped below this low. We get a sign of reversal. And then on the next candlestick, this is where you should be looking to enter the market long with this candlestick here. On the retracement, even if in this situation, if you move on to the lower time frame, you will see that there will be a sign of an entry here. Let's look at the 1 minute. You will see a sign of entry around this area. It's just that in the lower time frame, there was no candlestick that I will enter the market with right here. Because of this candlestick alone, it shows a sign of bearish here. Even though we get a bullish engulfing candlestick. But it doesn't mean you have to confirm with one time frame. You can still use another time frame like the 3 minutes, even the 5 minutes. Let's look at the 3 minutes here. Okay, even on the 3 minutes time frame, we just get this bullish candlestick. And obviously, I will enter the market because of this strong bearish move to the downside. Every time when I see a strong bearish move to the downside, and then a bullish engulfing candlestick, I can even say that we have this demand zone here. But if I don't get a confirmation, if price does not break this high, then I'll wait. But obviously we get another confirmation by this strong move to the downside, and then we reject here, and then that is why you see this move happening in the market. And then we create this fair value gap. That's how at least you can try to understand it. Every time when you see a fair value gap, when you are in a trade, you just know that that market might potentially move to the direction that you have anticipated. That's the only way you can try to understand this. Every time, every time when you see a fair value gap being created multiple times, you will see that the potential of the market is to push lower and lower. That is why you see a lot of fair value gaps. So let's say right now you entered the market right there, and then you start to see some fair value gaps. That's a sign that you might need to hold that trade for a longer period of time, but it doesn't happen a lot like that. Okay, to move some drawings, you can clearly see even the benefit of this indicator. Right now we have this higher high, and then we have this higher low, and we are making a change of character here, but obviously everything will just change based on the market. So every time when you use any indicator, don't go in blindly, because you have to confirm with your strategy, analysis, and even other technical aspects that you use in the market. That's the only way I can try to give you advice on, but I'm not a financial advisor. Here is another example on the US 100 here. Basically, you can see that we traded almost below this price point, but if you look at the current price action here, we even broke this low. Look at the current price action, what is happening in the market. It tells you that we are rejecting to the upside. This is a sign that we might be reversing, and then we confirm with this one here. This is where you should enter the market. You enter with this candlestick, and then when price creates this fair value gap, that means you are in deep right now, and you can still try to make a snapper entry after this confirmation here. You can still try to enter around this area, and then you can long like this, put a stop loss just below, and then you target another high, which is the previous high here. And you can see by using this indicator, you can just identify the higher highs. And if you want this indicator, you will find the link in the description below with a discount code just to help the channel out to get more free videos like this one. So this is a 1:8 to what on this trade alone, and we can see that after we have this fair value gap, that means that now we might be pushing very strong to the upside. You just have to understand that. So basically on this video, I just wanted to share that if you see a move that is happening in the market, and then you are in the trade, and then the market creates a fair value gap, that means you can still hold a little bit longer just to catch those pips. Okay,